Hello, everybody. Welcome to this Top FinTech and Payment Trends webinar for 2023. Today, we'll be going through some of the key trends that we expect to unfold in this market over the next year. I'm Nick Maynard. I'm Head of Research here at Juniper, and I'm joined today by Jordan Brooks, who's a Research Analyst here at Juniper as well. So let's go through what we're going to do today. So we're going to speak very briefly about us. Then we're going to introduce what our trends are, what the format is. Then I think it will be a surprise to no one that there are a few macro trends in the overall economic situation, which will have an impact on the fintech and payments market, which we'll talk about as well. Then we'll get on to the top trends for 2023 we expect specifically. And then at the end, there will be a question and answer session for you to be able to get your questions answered as well. So just to talk about us for a moment. We were formed in 2001, and Juniper Research is a mobile and digital market specialist with a worldwide client base. And we work with lots of the world's leading organizations. You can see a sample of those to the right here. So I think those speak for themselves. And we provide both off-the-shelf research and bespoke content across more than 90 research topics over a wide digital ecosystem. So lots of experience there, and feel free to check all of that out. So this is our fourth set of end-of-year predictions for the fintech and payments market. And we'll be specifically looking at what's the trend, why is it going to happen this year, how will the economic downturn impact this, and what are we actually predicting? What fundamentally is going to happen? The attention will be on key product launches, planned legislation that may impact, and what we expect to be announced at some of the showcase events this year. We're going to go from 5 to 1. And as I mentioned, the webinar will be followed by a question and answer session. You will see on your screen that you have a chat box. There you can enter your own questions, and time permitting, we'll get to those at the end. If we can't, we will come back to you individually on email following the event. So with all of that introductory content out the way, let's talk about the general economic situation and how that impacts the fintech market. So what we've seen, and I think this is really clear here on the graph to the right, is that major economies have been beset by inflation rates which haven't really been seen in recent times. We can see the massive jump that has happened in 2022, and that's having a number of knock-on impacts into the market. We've seen a major cost of living crisis for consumers, and that has meant real struggles for businesses too. And I think we're only starting to see the impact of that now. And in the fintech market, when economic circumstances aren't going as well, we see a lot of knock-on impacts. Credit becomes popular, and indeed we're seeing a lot of interest in buy now, pay later. And also there is the risk of fraud, which again is heightened during times of economic difficulty. And we have also seen that the broader tech industry has seen a lot of major layoffs. I mean, I think we will have all seen the news that seems to come every day about job losses in the market. And the fintech market hasn't been immune to that at all. Here, for example, you can see some major names here on the right that have announced significant job losses in recent months. And this is just sort of the tip of the iceberg in terms of some key examples. And one of the reasons for this is that governments have combated rising inflation by actually hiking up interest rates. What that means is actually the cost of borrowing is so much more expensive than it was. And that has a real knock-on impact into the startup market. There's not as much cheap money in the system available. And that means that it's not as easy to raise money. And we've seen that reflected in a lot of cases where valuations for new funding rounds have been significantly lower than previous examples. And that means really we're seeing a much greater focus on profitability earlier on for fintech startups. That sort of cash burn to acquire customers at any cost, that model doesn't really work as well as it used to. So we're seeing the impact of that. And What this means for our trends is, like we say, we're going to see more shorter term bets that can contribute to that profitability at an earlier stage. And businesses will be keen to take advantage of the opportunities fintech provides to reduce operational costs. And there's some key ones in there, lowering the cost for merchants to accept payments, for example, and a number of others we'll come on to throughout this webinar. So that's just a bit of background as to the overall situation and how that impacts on our trends. Now we'll get into the trends themselves, and I'll hand over to Jordan for our first trend at 5 on soft POS.
Thank you very much, Nick. So for our first trend, we are looking at how we believe that the point of sale terminal market is set to transition towards soft POS as Apple sets a market entry. With Apple having recently entered the soft POS market with their solution Tap to Pay, we believe that there is going to be a massive influx of soft POS solutions, which is really going to transition the point of sale market towards soft POS solutions. With iOS devices now being opened up to enable soft POS solutions on them, millions more users will gain access to these solutions for the first time. This should help to accelerate the transition towards soft POS and really drive demand for the market. As such, we believe that there could be a transition away from more traditional forms of POS, such as MPOS in particular, which has traditionally focused on small and micro merchants, and we expect that these will eventually transition towards soft POS solutions instead. So why 2023? We believe that, of course, following Apple's market entry, this is a massive change to the market status quo. We believe that with Apple opening up their ecosystem to third-party developers, with Stripe having already announced they will be the first third-party vendor to offer their own tap-to-pay solution on Apple's ecosystem, we believe that there will be an influx of soft POS solutions developed for iOS devices. Furthermore, following the COVID-19 pandemic, there's been a massive rise in the use of contactless payment methods. As such, smaller retailers and merchants in particular are looking for ways to begin to accept contactless payment methods. SoftPOS is an ideal solution for this. It is convenient, it is cost-effective, and it enables small and micro merchants to accept contactless payment methods. As such, we believe that there will be a real drive towards the SoftPOS as a standard within the industry going forward. The economic downturn is also said to have a significant impact on the soft POS acceleration. We believe that as businesses will be facing increasing pressure to reduce costs, maximize profitability, they'll be looking to cheaper point of sale solutions. Soft POS is an ideal solution. Soft POS eliminates the need for traditional hardware costs by allowing soft POS to work on devices that merchants and retailers already possess. By eliminating this cost, businesses will be able to see cost savings while still accepting the same number of payments and offering a contactless payment method. As such, we believe that during this time of economic downturn, there will be a real demand for soft POS solutions. As you can see on the graph on the right-hand side, we believe that by 2027, there will be more than 34 million soft POS users. This is up significantly from just 6 million in 2022. So who benefits from this trend? We believe that there will be three key beneficiaries. Firstly, merchants are set to benefit. This is because they will have access to this cheaper and more convenient POS solutions that are capable of accepting contactless payment methods, meaning that they should be able to maximize sales, revenue, as well as profitability by reducing these costs of operations. Furthermore, soft POS vendors themselves will benefit. This is because they will have access to a previously untapped market filled with millions of potential customers who should be looking to use soft POS solutions in the future. Furthermore, consumers will benefit as well, as for the first time they will be able to pay in contactless payment methods in a wider variety of businesses. This is especially going to be key and seen most importantly for micro merchants such as taxi drivers and food stalls who typically only accept cash. For more information, please check out our link on screen, which will take you to more information about this report. And I'll pass you over to my colleague Nick for our next trend.
Perfect. Thanks very much for that, Jordan. Learning all about soft POS there. For number 4, we are moving on to synthetic identity and the fraud market. So what do we mean here? we predict that synthetic identity will challenge how ID verification systems work, and that will lead to an ongoing fraud arms race in that market. So let's break this down. Fraudsters fundamentally are looking for new ways to make money as online activity continues to surge. And this is something we saw in the pandemic. We had a lot more digital users. We're still seeing the ramifications of that, as that has been a permanent shift in consumer behavior. And that means there's a lot more activity online, and there's a lot more payments occurring online. And there's a lot of implications of that. In this case, one of the things that has fueled is the rapid growth in data breaches. And we can see to the right here, we are forecasting that the total number of exposed records per annum globally will increase by 33% by 2027. So that's a real jump here, and is showing that there is a significant increase anticipated. What that means is that when these breaches occur, that provides little snippets of data that can be used to fuel even more fraud attempts with things like credential stuffing, where genuine credentials are combined with fake and synthetic ones. So this is a real problem that we are seeing in the market, and this is really growing. We're also seeing deepfakes here. Deepfakes, I think everyone will have seen these in wider society being used sort of in TV programs and on the internet. And this is becoming a more popular area, and there's a lot of development ongoing. We're getting to a point where actually these deepfakes can confuse and bypass existing systems. So this is all this all generates challenges and leads to actually a very difficult situation within the fraud management market. Now, why 2023? I think what we've just seen is that data breaches are running at a very high level. They are really having an impact, and every day seems to bring news of another significant data breach. And I think what we've also seen is that digital onboarding has become really prevalent. The pandemic sort of started that, but we've seen a lot of development in digital onboarding besides that. However, there has been the tendency to see that digital onboarding as, okay, I've secured the start of the process, that's fine. But what we really are seeing is that securing that onboarding element is only one part of a much wider risk that vendors face, with things like account takeover fraud being really massive. So actually, the zero trust strategies that go along with this and need to complement the use of more fraud systems, they haven't been developed as much. So we need further development on those to really secure risks in this market, and that will be a big factor this year. Now, the economic downturn. I think I mentioned this before in the introduction, but it is really important to note that fraudsters during economic downturns always are looking for opportunities, and sort of the maxim that keeps being said is fraud flows where money goes. So that is a very significant trend. And as we've seen more online activity, that has naturally translated into an increased level of fraud. That means fraud will grow significantly. And we can see evidence of that to the right. Our forecasts have the global transaction value of e-commerce fraud reaching $96 billion globally in 2027, which is a huge number and reflects that transition from card present to card not present fraud in an online scenario. So that's really significant. And businesses during this economic downturn are struggling to invest what they need to into fraud prevention. Their budgets are tightening, and at the same time, they need to prevent that fraud. So that's a real tricky situation for businesses and merchants to be in. So what are we predicting here? We're predicting that as synthetic identity becomes a real major challenge, system vendors are going to have to advance their game. They're going to have to invest in AI, and they're going to have to develop new ways of performing liveness checks and really getting to the bottom of these fraudulent attempts. We're going to see a lot more on zero trust in terms of how you actually make that more widely applied and how you get these prevention strategies end to end for the customer journey. And we're also going to see fraudsters upping their game. There's going to be more tech to attack systems, and we're going to see that ongoing arms race throughout the year and beyond. So you can see to the right, the global spend on AI-enabled financial fraud detection and prevention platforms in 2027 will be $10 billion. So it's a really significant market. And for more information, you should have a link on your screen now so that you can click for further information on this particular research and trend. So with that, it is to number 3 on instant payments, and it's back to Jordan.
Hi there, thank you very much, Nick, for passing it back. So for our newest trend, we are looking at how the EU regulation and the launch of FedNow within the US is set to catalyse the instant payments adoption and really drive the instant payment market. So what we've seen is that the EU has recently mandated that banks within the European Economic Area must offer and accept instant payments at no extra cost to the user. Furthermore, we're also seeing that FedNow, the US's own in-house instant payment service, is set to be launched within mid-2023. This will help to facilitate instant payment adoption across the US and really help to drive instant payment adoption within the North American market. What we believe to happen is that as these mandates and regulatory changes occur, we really expect that consumers will have greater ability and therefore greater willingness to adopt instant payments, which will really help to drive the market forward in the future. So why 2023? This is a simple one because the regulation and FedNow launches are both set to happen by the middle of this year. We really expect to see that consumers will get on board with these changes very quickly and help to drive the instant payment market across both Western Europe, the EU, and North America. But what does this mean? Who benefits? So we believe that with instant payments becoming more prominent, there will be increased and improved cash flow for both businesses and individuals alike. This means that there will be less need for both businesses and consumers alike to rely on short-term loans, bringing cost savings, and really helping to manage cash flow better. This can help with business practices as well as help individuals plan their budgets more effectively and really help to improve the standard of living. Furthermore, because the EU mandate is removing the premium that banks often typically charge for instant payments, this will save both businesses and individuals money in the long term when making instant payments, which will not only help to drive instant payment adoption, but will really bring cost savings for those that already use them. As you can see on the right-hand side, we believe that instant payments, particularly within West Europe following this EU regulation, is set to increase dramatically, exceeding 45 billion by 2027. So for our main prediction in this space, we believe that there is set to be an influx of instant payment solutions within the market. This is because vendors are going to look to capitalize on these regulatory changes and the launch of FedNow within the US market. As such, we believe that this is going to really drive demand and supply of instant payment solutions, which should create a more competitive landscape, delivering some more competitive and innovative instant payment solutions to the market, offering consumers and businesses alike a much more healthy, competitive solutions to choose from. Furthermore, with instant payments being a key use case of open banking, we believe that this will really help to drive the open banking market, helping raise consumer awareness and helping to really further the state and consumer trust in open banking services, which should be a massive impact on the overall open banking market as well. I'll now hand you back over to my colleague Nick for our next trend.
Perfect. So thanks very much, Jordan. Now we are on to, I think, one of the most high-profile topics within the fintech and payments market, one that I'm sure a lot of people will be familiar with, central bank digital currencies. So what we're predicting here is that central bank digital currency pilots will rapidly accelerate, and that will be as governments seek to better control their own payment infrastructure. So the trend we're seeing here is as I mentioned, CBDCs have become very prominent. They're taking a big role in public discussions around how future payment systems should be built and actually how they should be developed and accessed in the market. I think there's a fear that with the advent of cryptocurrency and things like stablecoins, governments don't have the same level of control that they used to in terms of their payment systems. And actually, they don't have control over the card schemes or those types of payment networks either. So CBDCs, which can actually directly appeal to end users, that is appealing to a central bank. That offers them something different, and that offers them a way to sort of take back more control of how their payment systems function and what that means on a day-to-day basis for end users. And there are massive considerations here, such as boosting financial inclusion in emerging markets where the level of smartphone penetration or mobile penetration is much higher than banking penetration. So there is a really significant cause for the development of CBDCs further in the market. So I think we'll see a lot of activity here and those pilots accelerating. And why do we think this is going to happen in 2023? Well, there's a few reasons to think that we're going to see a rapid acceleration. We've seen a lot of existing pilots surging forward. Many people may be familiar with the fact that China have been piloting the digital yuan. So that is a really significant area of development. And we've seen a lot of expansions of that pilot scheme, involvement of merchants in that as well. So there's a lot of development ongoing, and we think that is going to accelerate into 2023. We've had others who haven't really, to this stage, committed to a CBDC strategy, like the Bank of England in the UK, have been discussing trialing systems, building those CBDC systems, and actually, having a plan for longer term development. And the other element of this is that commercial partners involved in CBDC projects are beginning to start commercializing this. They're actually creating systems that are products that have distinct features, that have differentiation. So that is a really important consideration and something that we haven't seen to date massively in this market. So that's really important to note. So those are sort of the key reasons why we think this is really going to accelerate in 2023. Now, thinking about the economic downturn, longer term, CBDCs do have the potential to shake up how the payment industry works and actually lower costs in some ways. I think it will come as a surprise to no one that with traditional card payments, there are a lot of costs that go with that. It can be expensive for merchants, and there are a number of cases in which cost is generated. CBDCs can actually reduce that cost, and having a central bank system running this is a way of potentially reducing that. That is quite appealing in the present situation, which I think is a key reason. And we have seen a lot of interest in things like government-to-person payments, welfare distribution. If you think about the financial inclusion aspects of CBDCs, then there's a lot of potential for them to be used in that way and actually being used to distribute funds to citizens and better serve citizens. So there is an alignment between actually what governments want and how they can achieve that by developing a CBDC. So we're predicting that there'll be a significant increase in CBDC pilots. We believe that there'll be a more explicit understanding that actually sovereignty and controlling payment systems centrally is a reason to support CBDCs. There'll be a much more acknowledgement of that. We're going to see more commercialization of CBDCs by the wider market. We'll have set products. There'll be value-added services. And we're going to see a steady increase in payment volume as pilots translate into actual deployments in the marketplace. And to find out more, we have a report on this, and you can click the link on your screen to get more information on that. So without further ado, let's go on to trend number 1 on open banking, and I'll hand you back to Jordan.
Thank you very much, Nick. So for our number one trend, we are looking at how we believe that open banking is really set to challenge the role of card payments, especially within the e-commerce landscape, helping to transition the e-commerce landscape as it currently is. We believe that we will see that consumers will start to shift from card payments to more open banking enabled payments en masse, considering that they can really simplify and streamline the customer journey. With one-click payment options and pay directly by bank features, really being able to streamline and eliminate some of the traditional hassles and burdens of card payments, we expect that consumers will switch due to the added convenience as well, which will have benefits for both businesses and the consumer alike. What we believe is that because of increasing efforts to educate consumers about open banking features, we believe that there's going to be, raised consumer awareness about open banking, which is really going to help to drive this transition. Whilst there has been talk, particularly between regulators, about whether they should be involved in the process of educating and raising awareness for open banking, much of the burden has currently fallen on vendors operating in the space, and so far they have managed to do this quite successfully, particularly with the market entries of some of the larger and well-known card players such as Visa and MasterCard entering this open banking payment space. This has really helped to improve consumer awareness and consumer trust of these services, which is really helping to further push this transition towards open banking payments, especially within 2023. We also feel that with rising e-commerce integrations, there will be further awareness raised as these solutions become more prominent and more apparent for consumers to use. This should help to encourage further adoption and really help to push this transition within 2023. Of course, the economic downturn is also going to have a significant impact on this transition. One of the key benefits for businesses of open banking payments is that they have a far lower interchange fee than card payments do traditionally have. As such, businesses who are in need of saving money quickly and efficiently can turn to open banking payments to pay lower fees on their payment acceptance rates. This can save significant amounts of money in the long run and really help businesses to maximize profitability at a time when it's needed most. Furthermore, as my colleague Nick spoke about earlier, at a time of economic downturn, there is a high risk of fraud. Open banking can help to lower this threat. Consumers are authenticated by their bank directly, which means that there is a lower risk of fraud, and bank and businesses have a higher rate of successfully countering fraud. This can lower the risk of chargebacks and refunds and other costs typically associated with fraud, helping to save businesses further money, improving their profitability, and further helping them in their journey to remain profitable in a time of a cost of living crisis and an economic downturn. This is vital, as you can see on the right-hand side, looking at some of these inflation rates we've seen in recent years and the prediction that is set to carry on for the foreseeable future. As such, this need to really save costs is going to be vital for businesses going forward. So who do we think will benefit from this transition? We believe that consumers will have a primary benefit from a streamlined and more convenient payments journey. By eliminating the need, for example, to manually enter payment details on each time you make a card payment, open banking payments can really simplify the payments process. This benefits businesses as well, as open banking payments have been shown to have a higher acceptance rate than card payments. This can help businesses avoid lost sales and lost revenue. Furthermore, open banking payments have been shown to have a higher conversion rate than traditional card payments. This is primarily due to the streamlined payments process, which makes following through with online and e-commerce shopping experiences more enjoyable and more likely. As such, businesses can really expect to see higher revenues as well as lower costs, helping to maximize their profitability. So what do we feel this means for the market? We believe that open banking payments are set to surge in popularity, primarily driven by this convenience they offer greater than and goes beyond the possibilities offered by card payments. As such, we believe there's going to be an influx of further investment into the open banking payment space, with more mergers, acquisitions, and new startups being launched to really try and target this market. We also believe that there will be an increase in the number of banks that are willingly and voluntarily supporting open banking payments. Up till now, we've seen that most of the support for open banking payments has been regulatory driven. As such, with the CMA9 in the UK, we believe that as open banking payments start to see greater adoption and really rise in prominence, that banks will be more willing to voluntarily integrate these solutions into their services and help to grow the market. As such, By 2027, we believe that open banking transactions will exceed a value of 330 billion by 2027, with West Europe accounting for a significant portion of this. We really believe that as open banking payments become more prominent, this will help to expand and really grow the strength of the open banking market in general, really helping to push on one of fintech's most prominent and most promising market trends. For more information, please do click on the link you should have available on your screen now. I will now pass you back over to my colleague Nick, who will give you a run through and a summary of the trends we have.
Perfect. So thank you, Jordan. So at number 5, we had the POS market to transition to soft POS, as Apple sets an example for the market. We had synthetic identity and ID verifications and fraud at 4. We had EU regulation and launch of FedNow driving instant payments adoption at 3. At 2, we had CBDC pilots rapidly accelerating as governments control their own payment infrastructure. And at 1, we had that role of open banking for challenging card payments. So we are short of time, but we will cover just a couple of questions that I've seen come in during this webinar. So one question from Joshua: how do you see a conversational AI, conversational commerce playing a role in fintech in 2023 and beyond? I think this is a really important trend in terms of actually getting the payment transaction and the payment capability as close to the customer journey as possible is advantageous. That lowers the risk of somebody leaving the process. It gets the payments closer to where they need to be. So we think that is a significant trend that will have an impact going forward. We do have a report on conversational commerce available, and feel free to check that out. But we do think it will be very significant. We'll see more integrations in with things like chatbot platforms and those kinds of systems going forward. The other question I was just going to clarify a little bit on was we had a question from Myra on the Chinese CBDC, which quite rightly they've stated that China has given away millions of it to encourage uptake of this. And does this mean that we are predicting too strong or too easy adoption? And I think that's a fair point in terms of, obviously, with new systems, there will have to be incentivization. The Chinese example has seen a lot of that, but I think there's a lot of different ways to incentivize use. Fundamentally, it's about making it as appealing as possible to the user. That means signing the right partners, getting the right ecosystem, and getting the right levels of merchant acceptance. And that will be the same for a lot of other competing payment systems. Open banking, for example, it's all about acceptance. And that's why open banking is starting to really gain popularity now. So I think we will see a lot of different strategies around incentivization, but that will be something governments focus on going forward. And anybody we haven't answered your question, we will get back to you on email after the session. So thank you for that participation. So for any questions, there are some contact details on screen. There will also be a white paper available to download. So there should be a link on your screen to request access to that white paper, and that will be available on our website with more information on all of the trends that we've talked about today. With that, all that's left for me to say is thank you very much for your time and attending our webinar today. Please feel free to reach out and ask us questions about any of the content. And it's been an absolute pleasure talking to you today. And it's goodbye from us for now.